Hello, my friends. Today is April 6th, and this is Markets Weekly. So, this week was a really volatile week in markets. We got some notable down days and some notable up days. Now, taking a step back, it looks like we are moving out of the steady upward channel we've been in over the past few months. That suggests to me that we are in a period of consolidation/correction. Now, nothing goes up in a straight line, so personally, I think that the highs are not yet in for the year, and I am looking to buy the dip. Let's see how that turns out over the coming weeks and months. So today, I want to talk about three things. First, let's talk about gold. Now, gold is absolutely surging, and to some extent, its little brother silver is doing well as well. Let's talk about what could be driving this sudden upward surge in prices. Secondly, this past week, the Treasury began on a very small scale its buyback operations. There seems to be a lot of interest in this and also a lot of confusion. Let me break down what's happening. And lastly, let's talk about how the market is actually outhawking the Fed right now. So over the past 2 years, the market has persistently priced in more rate cuts than the Fed has guided towards, sometimes a lot more. But right now, the market is actually pricing in fewer cuts than what the Fed is guiding. So let's talk about what could be causing that. Okay, starting with gold. Now, let's look at a chart of gold prices. It looks like it's going straight up like a rocket ship, especially the past week where it looks like it's almost vertical. Looking at silver, which is also a precious metal, but also a part industrial metal, it looks like silver is breaking out as well, although to be clear, the chart is not as clean. Now, gold is one of these interesting assets where there are many different perspectives on it. Let's go through a few of these to try to figure out what could be driving this upward surge. Now, if you are a traditional macro investor, you would look at gold through the lens of real interest rates and as a currency. The thinking being that, let's say, if real interest rates were negative, well, instead of having your money evaporate, let's buy something like gold, which is at the very least tangible. Now, after the great financial crises, now real interest rates were negative, and it seems like that was contributing to upward pressure on gold prices. But fast forward to today, if you look at real yields as proxied by 5-year tips, you can see that real yields are historically high at 1.9%. So it doesn't seem to be a driver for gold's price action. Now, some people think of gold as a currency, so that, let's say, when the dollar appreciates, then gold prices should go down, and when the dollar depreciates, gold prices should go up. But if you look at a graph of the dollar index, you can see that the dollar has been very much range-bound for the past few months, so that's not a driver. Another potential driver is the stance of monetary policy. Now, we all know the Fed is embarking upon a cutting cycle. But over the past week, though, interest rates have gone up. And if you are thinking about, say, more of a quantity of money kind of perspective, the Fed continues to steadily shrink its balance sheet through quantitative tightening. So it doesn't seem like that has been the big driver, at least over the past couple weeks. People also note that there are a lot of foreign central banks buying gold, and I think that's definitely true. Let's say if you are, a big country with a lot of foreign reserves, obviously you want to diversify your foreign reserves, maybe out of the dollar, maybe into gold. But that seems to be something that's been happening in the background over the past few months, and not something that suddenly surged the past week. Now, what seems to be the big driver in gold prices is geopolitical tensions. Now, gold oftentimes also reacts to geopolitical tensions. Now, this past week, we had Israel bomb an Iranian embassy in Syria. Now, bombing an embassy is definitely next level escalation, and it seems like the market is reacting to this. If we look at oil prices, which are also, of course, sensitive to geopolitical developments in the Middle East, oil prices also seem to be moving upward as well. Now, when I look at, say, on a company perspective, oftentimes I see, let's say, a company has an earnings announcement and then the stock price has a big move. But when you look closely, oftentimes it seems like there's someone positioning in the options market before that announcement. That is to say, someone knew what was happening. I imagine this is probably similar for for governments. After all, if a government needs to do anything, there are thousands of people involved, and someone always knows in advance. So what we could be seeing is just that over the past 2 weeks, there have been more and more people trying to position for what could be escalating geopolitical tensions. It's hard to say. Now, one other thing to note is that going forward, the traditional flight to safety in geopolitical tensions may be different than it has been in the past because of what happened during the Russia-Ukraine war. Now, during that war, the US and NATO, Western European countries, froze the foreign reserves of Russia and right now are thinking about giving that money to the Ukrainian government. So I imagine that that's probably going to have mess with some of the traditional relationships we see, let's say, flight to dollar, maybe flight to treasuries in times of geopolitical risk, because there might be some foreign governments that are not willing to do that anymore. But we'll know more as time goes on. Typically speaking, these geopolitical flare-ups are something that you should fade. Look at what happened during the Russia-Ukraine conference, that spike in oil prices and so forth all faded down. But of course, if you fade too early, you could still end up with a lot of mark-to-market losses, even though eventually things blow over. So keep that in mind as well. Okay, the second thing that I want to talk about is the Treasury buyback program, which began this past week. Now, it began very, very small scale, but I think there's some confusion as to what's actually going on. So let me talk about what's happening and then why the Treasury is doing this. So the Treasury buyback program is, as its name suggests, the Treasury is buying back its old debt. Now, it's doing this for two reasons. First, to improve liquidity in the Treasury market, and two, to better manage its own cash. Now, let's talk about the second point first. So if you are the United States government, you have, like any other business or any other individual, inflows and outflows from your checking account. If you are the US government, the biggest inflows that you get every year are going to be tax related. Now, quarterly, you get tax payments from corporations, but every April, you get these huge surge of tax receipts from the general public. Now, in the US, let's say individuals pay taxes on April 15th. So you can see basically every year, the Treasury's checking account has this huge surge in mid-April when everyone goes and pays their taxes. Now, this is fine, but let's say that you're the Treasury and you suddenly have all this cash that you don't really know what to do with. One of the things that you could to better deploy that cash is if you use that cash and to buy up some of your debt so that you would not have to pay interest expense, basically saving the taxpayer some interest expenditures. So this buyback program would allow the Treasury to have that flexibility. And a second thing that this buyback program would do is it would help improve liquidity in the Treasury market. So taking a step back, the Treasury market is a lot messier than the equity market. So let's say that you want to buy Apple stock or Microsoft stock. Well, there's just one ticker, MSFT, and you know how to buy it. But the Treasury market is a lot messier because there are many, many, many different Treasury issues. Let's look at the 10-year Treasury, for example. Now, let's say today I issued a 10-year Treasury security. That security gets what's called a QSIP. A QSIP is like a ticker for the bond market. But what happens is that US Treasury issues a new vintage of this 10-year Treasury security every 3 months. So right now, I'll issue let's say I'm the US government, I'm issuing a new 10-year Treasury security. 3 months later, I'll issue a new one with a new QSIP. And then 3 months after that, I'll issue a new Treasury security with a new QSIP then. So just one security can have many different QSIPs because, again, the Treasury continues to issue debt. Now, in practice, liquidity in the Treasury market is concentrated on newly issued Treasuries. We call these on-the-runs. So if you look at this chart here, you can notice that almost all the transaction volumes for a certain tenor are concentrated in on-the-runs. So if you're an investor and you hold, let's say, a 10-year Treasury security that was issued a few months ago and you want to sell it, it might take longer than you want and you might not get the best price. Now, one way to improve liquidity in the Treasury market is if there were fewer off-the-runs and more liquid on the runs. The US Treasury is hoping to do just that by, let's say, issuing an on the run US 10-year and using the proceeds to buy an off the run 10-year. The US Treasury is very clear that it's not aiming to change the maturity profile of its debt, it's just aiming to improve liquidity. Now, when you look at the contours of this program, what you should notice is that it's not going to be very large. So again, it's just beginning, but right now the US Treasury is guiding towards, say, $120 billion worth of cash management purchases, and when it comes to Treasury liquidity purchases, about $100 billion a year. So these are very small numbers in light of the ginormous Treasury market. But government programs always start like this. They start small, and over time, as the government becomes more comfortable with what it's doing, it could grow. So potentially in the future, this could be a much bigger force on market dynamics. And maybe if we have some kind of emergency, this could also, of course, potentially be used to change the maturity structure of the Treasury's debt. Again, we're in the early phases of this program, and it has potential to be much, much more than what the Treasury is saying right now. But we won't find out until an emergency happens. Okay, so the last thing that I want to talk about is how the market is actually more hawkish than the Fed right now. So based on the Fed's March dot plot, the Fed has been guiding towards 3 rate cuts this year. The market is right now suggesting that, maybe the Fed is just going to cut 2.5 times this year. So the market is being a bit more hawkish than the Fed, which is surprising because recall, as recently as January, the markets were pricing in as many as 7 cuts this year, even when the Fed guided towards 3 in December. So this is kind of a change in the market's reaction function. Now, this change seems to be driven by better than expected data. So this past week, for example, we had the ISM manufacturing data print above 50 for the first time in several months. Now, the way the surveys work is that when it's above 50, it suggests that the manufacturing sector is expanding. So it looks like we're at a turning point where manufacturing is getting better. Of course, the big data print we got was this past Friday, the non-farm payrolls, where payrolls show job creation of over 300,000 the past month. 300,000 was higher than all the estimates by Wall Street economists. When you look at the details of this job report, continue to be quite positive. Again, in addition to the headline, we also had upward revisions for jobs over the past 2 months. We had the labor force participation rate tick up slightly. And of course, wage growth continues to be fine. Now, there are some people on the internet commenting that a lot of the job growth was through part-time job growths. But again, Guy Berger here has a very good chart that breaks down that part-time job growth could be due to a couple reasons. It could be for economic reasons or non-economic reasons. Now, if it's for economic reasons, maybe potentially sign for concern. But if you look at his chart, you can see that there really hasn't been that much of a pickup. Now, people could have part-time jobs for non-economic reasons as well. Think about all the people who are retired. Maybe they want to have something to occupy their time. Or maybe you're a housewife and you would like something to occupy your time as the kids are at school and so forth. So, people do work for non-economic reasons. Again, jobs data has been positive. And in addition to that, I think Chair Powell has actually been changing his tune in how he interprets labor market data, in large part due to the tremendous amount of migration that we've had the past year. And that's what I'm going to be writing about in my blog this week, and how this change in the Fed's reaction function suggests that the market may be misunderstanding what the Fed is thinking. Now, one other reason why the market may be pricing in a more hawkish Fed is that there are signs that maybe inflation might be picking back up. So again, we talked about how oil prices were elevated. Well, that of course feeds into inflation. But if you look at other commodities like copper and aluminum, it seems like they seem to be moving up a bit as well. To be clear, iron ore and steel are in downtrends. So it's not an unequivocal picture. But if you look at, say, break-evens, so market measure of inflation, break-evens seem to be slowly edging upwards. Still, just 2.5%, nothing to worry about, but it seems like the market is becoming a little bit more concerned about inflation staying higher than expected. So it could be due to all of this, looking at higher commodity prices, stronger than expected US growth, Atlanta Fed GDP now projecting again US GDP to expand at comfortably above 2% this quarter, that the market is beginning to be a bit more hawkish than the Fed. I suspect that is not the right reaction, but we'll see how things go over the coming months. Again, thanks so much for your time. That's all I prepared. And if you're interested in getting my latest thoughts, check out my blog at fedguy.com. And if you're interested in learning more about markets, check out my courses at centralbanking101.com. Thanks so much. Talk to you all next week.